Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smollenberger, the CEO here, will be your host as you go behind the designs.
All right, welcome back to the podcast. In our last episode, we talked about asset allocation and how it changes across your lifetime. And so this is a follow-up episode to that conversation where we really want to dig into target date funds. And again, we have Rob with us, who is our Chief Investment Officer. Welcome, Rob.
Great to be back. Thank you very much.
Yeah, and anytime we're talking about investments, it was so funny as we were getting ready for this episode. Check. Okay, we got our notes. I've got my pen, computer, whatever we need, and Rob's like calculator.
Yep. You never know when you're going to need it. You never know.
Exactly. I'm like, that is not something I think of. I think, I have a calculator on my phone. That works, but it does not have the same buttons.
No. This calculator I've used for like 25 years. It's just like, it's almost like an appendage at this point. I can't function without it.
And that is when you know you are born to be an investment advisor.
Right.
That's so great. Well, today that's what we're talking about. Again, investments. And sometimes you don't have all the choices in the market to invest in. So, in our last episode, we were really talking about here's how you want to think about choosing your investments, how to begin doing that. But when you're limited to choices, maybe that your employer provides in your 401k, for example, but you still want to make the best decision possible if this is all you have. So we just wanted to be sure that we're talking about these because we know that they can be a big part of people's retirement accounts, even saving for education, these types of funds. And so it's something we want to touch on just so that people know, how to even approach or how to use and invest in them.
Yeah.
So,
Yep.
One of the biggest differences between, a custom created portfolio where you can choose from everything, which we talked about how that could be overwhelming to someone who doesn't know how to do it. But again, you can work with a guide to get help versus really a kind of a target date or kind of these set allocations is really more of a one size fits all. And so you're kind of choosing something that's good enough, does this work for me? And so I think that's kind of just one of very big and broad a difference that when we were thinking about this, the different ways you can invest, that's kind of like just a very big summary of how we think about it.
Yeah, I mean, that target date funds are, if you're looking to invest, I mean, you have, call it 1 to 3 ways to do it. You can hire somebody like us to do it for you, and we'll sit down, talk about your situation, get you invested, monitor it on an ongoing basis, and, just kind of go through life that way. Other people are like, you know what? I don't want to do that. I like to buy stocks, so I'm going to open my own account and trade, and I'll pick my own stocks or funds, and nothing wrong with that at all. But I mean, not a lot of people like to do that, and I've run into a lot of people. I used to do a little bit of consulting for younger, call it millennials, just starting out in their careers, and the number of times that people are like, I just have no idea. Like I have this account, I have no idea how to invest. Target date funds are sort of an answer or, a solution that the financial industry has come up with over the last, call it 20 or 25 years to help address somebody who wants to invest but doesn't really know how. And basically what they're there for is to kind of do a lot of what we talked about in the last episode in terms of how much should I invest in stocks versus bonds, depending on my time horizon. These funds will do a lot of that heavy lifting and decisioning for you. So they're a good way for somebody to kind of invest on your own, but you don't really know exactly what stocks and bonds to pick specifically.
Yeah. No, I think that's a really helpful explanation of kind of what they are. And I know you've spent time kind of going through different target date funds. We look at these for clients. So again, when we're saying, this may be the only choice that you have, for example, our clients may only have these in their 401ks. And so that may be the only choices that you have. So again, we want to work with what we have. We're really just saying, okay, again, how does this fit into all of the investments that you have? So I know you've done kind of a deep dive into, there's different companies that have different target date funds. And so really today, that's what we're going to be talking through, things that you found, kind of the pros and cons of these types of funds.
Yep.
So I guess just explain when we talk about like what is a target date fund, kind of explain like what is that?
Yeah, sure. Yeah. So a target date fund, we're going to focus on that terminology, but it is important to realize there's kind of like two flavors of it. So when you hear people talk about target date funds, what they're mainly talking about is funds that are geared for retirement savings. So at some point you're going to retire, and that fund is designed to help you meet that goal. If you have kids and you're saving in a 529, you'll see another flavor of target date funds, which they call age-based funds, which do exactly the same thing that target date funds, but what they're looking at is the age of your child, and they're making adjustments as they get older and closer to college. So we'll just call it target date funds just to make it simple. But basically what these funds do is, as we talked about, when you're investing, you want to have a mix of stocks and bonds. They both have their purpose. So what target date funds is, they will automatically change the mix of your stocks and bonds as you get closer to whatever goal you're working for. So if it's a kid going to college or you're getting closer to your retirement year, they will automatically de-risk your portfolio out of stocks into bonds, make it more conservative, so that when that moment comes where you're either retiring or your kid's going to college, you can be reasonably sure that the money is going to be there to pay for it. So they're really, it's kind of a form of automated investing. There's other ways to do it these days. They call them robo-advisors that kind of do it the same way. But target date funds are probably the most recognizable and easiest thing to understand.
Yeah. So you're kind of saying, I'm going to put, for example, just very simplistically, I'm going to put all of my money into this one fund, and because these are retirement funds, it's going to adjust as I get closer to retirement for my retirement goal.
Yeah.
Okay.
Yep.
And so we might see those, for example, it might say target date 2045 or something. So it's the year of that retirement, right?
Yeah. So the way these things are named is they kind of go in 5-year increments. So it'll be target retirement 2030, target retirement 2040, or something along those lines. And basically what that means is, I'm not 40 years old, but we'll pretend I am.
Yeah.
I'm 40 years old. I'm going to retire at 65, so that's 25 years from now. It's currently 2024. So that gets us to around 2050, call it. So if I'm going to invest in a target date fund for my retirement when I'm 65, I'm looking at that target date 2050 fund, because that is, the closest year for when I'm actually going to retire. And, so I start putting money in it and it invests. And as I get closer to 2050, when I'm ready to pull the plug and say I'm retiring, it will be invested mostly in cash and bonds so that I can live off of that.
All right. Now we're going to talk about, is that what you want? So, that really sets it up of, okay, I know it's automatically adjusting for what I should want or what they think people my age will want when they're retiring. And so it's really kind of, just the way we're describing this, kind of a one size fits all. Everybody who's in this target date 2050 fund is going to be invested, the same way, and it's this way. And so regardless of any other factors, like that's what it's adjusting for, is really age and retirement. So you kind of said there's target date and then there's the age-based. Similar, on the age-based for 529s, are they, how are those kind of named or titled, or how would people see those?
Yeah, so usually it differs from plan, but generally it'll be an age range. So you'll see an age-based fund for children between 3 and 5, and then 5 and 7, 7 and 9. And basically what they're doing is very similar to the retirement one. When your child is a newborn, they're like 3 years old, they're investing very aggressively in stocks to try to get that growth. But as they hit their kind of high school years, they're dialing that back a lot. So the way you would do it, or the way it's done in practice, is if I have a 3-year-old child, I invest in this age-based fund that for 3 to 5-year-olds. When they hit 6, that 529 plan will actually get them out of that and put them in the next one. for ages 5 or 6 to 7 or whatever it is.
Yeah.
But they kind of automatically just kind of move your child along. It's not like you have to go in each year and say, oh, my kid just turned 6. I have to physically get them out of this fund and into this one. That the plan will do that automatically for you.
Okay. No, that's helpful. Yeah, kind of to understand how they both work. So I guess what are the positives? What are the pros of these types of accounts? Obviously, like simplicity is a really big one.
Yeah.
I can just kind of put everything in, depend on it to do what I need. Anything else that are there other positives?
Yeah. I think we look at a lot of different 401k plans for clients, and I'm frankly shocked sometimes at just how awful the investment choices are. Even with really large companies, they'll offer funds that are either expensive or not well diversified or just weird, and it's just sometimes the choices just aren't really good. But most 401k plans these days offer these target date funds, and in a plan where the other choices aren't that good, a target date fund might look pretty good, because that way maybe it's a little bit more diversified or it's cheaper or something like that. But probably the biggest positive is just, if you are truly a set it and forget it kind of person, I'm going to put money in, I don't want to look at it, I don't want to have to rebalance it or anything like that, target date funds are a perfectly good option, particularly when you're kind of younger and in building savings. We'll talk about that in a little bit, but that's really a big one. You just don't have to worry about managing your investments. That particular fund will do it for you.
Okay. Yeah, so this is really, they're simple. Also, if you just don't know, this is kind of an answer for you. So it kind of helps those people who say, all right, I just need something, I need to figure this out. They go through their list of 401k choices. Oh, okay, that sounds good.
Yep.
So, okay.
Yep.
All right. Those are kind of the main positives as we see them. Here's good things about this. Now we want to talk about kind of the negatives or the cons of target date funds. And really, I think what's interesting is you were digging in, to prepare for this episode of there's different companies. So different companies have a 2050 target date retirement fund, and those could all be different. They might be similar, but they're all different too. And that's something that was really interesting when you're kind of highlighting. Why don't you walk us through kind of some of these things that you found as what you would say maybe they're cons of or negatives about using these types of funds?
Because of the rules and laws and regulations that cover financial services sector, what happens a lot is kind of mass market products, which is what target date funds are. They're designed to kind of appeal to as many people as possible. Because of all the compliance and laws and regs, it's a lot of times these products are just made very, very simple. So what I mean by that as it relates to target date funds is they might not be very well diversified. So they'll have a total stock market index for the US, maybe some international, and then a total bond market index in this thing. And that's what makes up the investments, which, can work for periods of time, but there are periods of time where that undiversified strategy does not work that well. So, that's one thing. The other thing is each company does approach. I was actually kind of surprised when I went through this yesterday, just how differently these big companies, and by big companies, I mean the Vanguards, BlackRock, T. Rowe Price is really big in target date funds. When you look at the way they kind of invest at these different target dates, it can be really different. And so it's not just just pick a target date fund. It doesn't matter who's selling it. Yeah. There's a lot going on underneath in terms of, how are they going to de-risk you as you get closer to retirement? Yeah. Are they invested in a diversified way? Some are better than others in that. Not all are great on that front, in my opinion, but some are better than others. So there's just a lot more going on underneath these things.
Yeah. No, I think that's helpful. And I know you were kind of sharing, here's a chart comparing at the different ages of the different funds. And I think that's just helpful to see. And we'll kind of compare to, somebody who's nearing retirement, maybe how we would kind of view things differently versus what you found. So they're not well diversified, meaning that there's a lot of asset classes. So you might own stocks, but maybe only U.S. stocks, not small and medium size. You might own bonds, but just kind of like an aggregate bond index. So you can't be really specific, which we're going to touch on too.
Yep.
What about, so I guess the other thing is, great, I'm getting return. So my funds are growing. How are these funds like expense wise? Do they cost? Like what's kind of an average cost, or what did you find?
Yeah. So the cost does vary a lot, but generally speaking, target date funds, the reason why big companies like them is because they can charge a little bit more. So generally speaking, you might pay like 0.5% or maybe 0.75% ongoing expense rate for them, which is not out of line by any extent, but I mean, you gotta pay for something, but there are, if you're a little bit more astute and maybe you have better 401k choices other than these target date funds, you might find that building your own portfolio, you can do that more cheaply or less expensively by doing it kind of fund by fund versus just buying a target date fund.
Okay. No, that helps. All right. So then I think one of the biggest things that I noticed in these funds when you kind of shared, okay, here's how they invest across ages, was really kind of once it got to retirement was how they were investing people and what that allocation should be. So maybe describe kind of what you found, what, you saw kind of closer to that retirement age.
Yeah. So the way to really kind of understand how target date funds work is to maybe break it into 3 age periods. Okay. So for very young people, if the target date fund is like 2050 or 2060, a long ways away, what you'll find is target date funds will invest you very aggressively while you're young. So we're talking like 95% stocks. Generally here at FDS, for our younger clients, we're talking 80 or 90% stock allocation. So you do want to invest aggressively. You do want to be in stocks. You have a long time horizon. But, just understand that in these target date funds, when you're young, you're almost exclusively in stocks. So when you go through a bear market, like we went through in 2020, or if you go back further in like 2008, you will see your 401k value drop precipitously because you don't have bonds or cash in there at all. It's really what are stocks doing. That, to be honest, I'm not too concerned about that. As you kind of get into what I call like middle life, your 40s and 50s, target date funds will generally invest you around 70 or 80% stocks, not out of line. My real beef with target date funds is as you get closer to retirement, in my opinion, they just massively de-risk you relative to the time horizon that you still have. So we talked about that on the last episode. Even if you hit retirement, you're 65, you're like, I'm retired, you may still have 25 or 30 years ahead of you in terms of, I need this money to last that long. And if you de-risk your investments too much, which is what these target date funds do, they will de-risk you to 30 or 40% stocks, which is a very, very conservative portfolio. It seems like, that seems like it makes sense. But if you are compounding inflation year after year for 20 years, and you're only invested 30% in stocks, I'm sorry, you're not really keeping up. You are, but you're not really getting anything above that. So my real beef with target date funds is as you get closer to retirement, I think they just invest you way too conservatively. So, maybe a big way to kind of say it is target date funds might be fine or are fine if you're really young and have a long way to retirement. But as you get into kind of your late 40s and 50s or whenever you're thinking about retiring, it's like, you know what, that fund probably is not going to be your best investment option for you.
Yeah. And I think one of the things that we did touch on in the last episode as well, but was really, retirement is such a big thing for most people because it's kind of this, I'm working toward this, I'm saving money, and then from this, I'm going to spend all this money from it. So I need it. So it is kind of a big transition in people's lives. It is an important time that they do want to be investing for. And so you want your money to be there when you need it. And so it's basically like, okay, so as after that point of retirement, does it just kind of stay in that allocation? It kind of just stays with it's like a 50-50 or 40-60?
Yeah. Yeah. So generally once you hit retirement age, what a lot of these companies will do is they will shift you into what they call a retirement fund,
Okay.
which is just you're
Okay.
retired, here's your allocation for retirement.
Got it,
So
okay.
30% stocks, 70% bonds, or maybe 50-50, depending on the company. But generally, you get transitioned out of that target date fund into what they call a retirement fund.
Okay.
And that just stays the way it is until you die, pretty
Yeah.
much.
No, and that's helpful. That's where it's kind of like,
Yeah.
okay, what happens after that?
Yep.
So what's interesting is we use our investments to grow our portfolio before retirement, but we still want to use our investments to grow those funds even in retirement because our expenses, a lot of times I think people will think, oh, I'm going to spend less, when I'm retired. They might, in the beginning, you might spend more because you might be traveling or doing hobbies, but they think, when I'm older, I'm not really going to be doing much. I'm not going to travel as much. However, everything you are spending on, those costs continue to go up. And so you need to be investing so that your portfolio is still going up to cover those costs.
Yeah.
So,
Yep.
So let's break out a little bit more. We're talking about the stocks and the bonds. This is where I think just kind of like being invested in a custom portfolio versus kind of the one size fits all. You touched on the diversification is kind of light. It's just, maybe stocks, bonds, maybe some international. But let's just break out kind of one of these pieces. So for example, bonds, like why would that matter? So in a target date fund, I'm just going to have kind of this, maybe an aggregate bond fund. So maybe describe kind of what that is versus, how we invest clients when we're saying we're going to customize, we're going to have this investment, this bond piece of this, but it's not just one fund. So talk about the difference between those two, especially, in light of when performance actually changes for
Yeah.
bonds, which is like the last 2 years when interest rates were changing. Kind of explain the importance of that.
Yeah. So a lot of these funds will invest in what's called a passive index fund. So you'll have a passive index stock fund, a passive index bond fund, which
Okay.
might be what they call an aggregate bond fund.
Okay.
And the underlying assumption is that investors and I believe in them. We invest in them for clients, not exclusively, but generally speaking. But the underlying assumption in a passive index fund is that the index is well diversified and structured correctly.
Okay.
And there are periods of time where that is not necessarily the best way to invest. So bonds over the last couple of years, this is a great example. If you were investing in the aggregate bond index in 2020, 2021, you were investing in an index whose sensitivity to higher interest rates was higher than it had ever been in the data I have going back 40 years. And at that time, interest rates were near zero. And all of a sudden inflation happens, and all of a sudden the Fed is like, we have to do something about this. We're going to hike rates. So a lot of those bond index funds that were just invested in this index with a lot of interest rate risk, they're not responding to, hey, inflation is a problem. The Fed is raising rates. We need to invest our bonds differently. They're just blindly investing in whatever index they're in. And those funds, those bond index funds, underperformed a lot in 2022 and 2023 just because interest rates went from 0 to 5%. It's like, that is a big change. Conversely, like what we were doing for our clients is we're invested in a very well diversified portfolio of bonds. We had actually started to de-risk our client bond portfolios in terms of interest rate risk all the way back in 21 because we were having concerns about inflation and the Fed is going to have to respond. And, while you can't shelter everyone from everything in a bear market, I mean, we definitely did a lot better than the bond indexes during that period just because we were able to respond to that. So that is kind of the rub with a target date fund is you can have these periods where they're kind of just invested in an index that may or may not at that given point of time be appropriate for your long-term investment health.
Yeah. And this is really where you're like kind of these bond examples is when interest rates were changing, you would want to own different lengths of maturity. So you might want to own short-term bonds, medium, long-term. And so you were able to make those changes because you didn't just own one big fund. You owned funds that owned those specific things and made changes as the time came. And so that's the difference of really, kind of what you're able to optimize. You're optimizing the growth you can get from that as it's happening, especially when you're looking back at history saying, okay, this is what has to happen. Rates are at 0 and inflation is crazy. The Fed is going to have to raise. And so it's just, as you're thinking about that, anticipating it, and looking back at history, you're making changes. So it's really this that's custom. These are changes that we're making that are ideal, and we believe that they're important versus I'm just going to own this and, okay, it's good enough. And so it's kind of just two different ways to view what you own.
Yeah. And again, those kinds of issues really become more acute as you get closer to retirement.
Yeah.
So, you're in your 20s and 30s, you're invested in these things. That is great. They work. And even if you go through periods where maybe their underlying investments aren't doing as well or the indexes aren't that great, I mean, over 20 years, it'll all kind of even out, so you don't have to worry about it too much. But again, as you're getting within 10, 15 years of retirement, you really do need to kind of pay a little bit more close attention about how you're investing so that you're ready for anything macro changes, economic changes. Those start to matter a lot more.
Yeah, and I think what's really helpful is as we start to kind of think of, okay, so when we've talked about when target date funds, these age-based funds, are useful, when they may be a good idea. But there are also times where not using them or being able to choose from everything out there and being able to have a customized portfolio that can take advantage of these changes as they come can be a better fit too. So just maybe explain kind of some times when it would be important. I know you've kind of mentioned some of this already. What are some times where it is important for people to really have that customized investment for them?
Yeah, I mean, I would really say is you're even starting to just think about retirement. You don't even have to have a date. It doesn't have to be set in stone or anything. But at the moment that you're starting to think about that very important life change, it is a really good idea to start, A, getting advice on that, and B, making sure you're invested for any decisions that you might make. So we had a number of clients who, before COVID, were saying, maybe in 2025 or 26, we're thinking about retiring. And then in 2020 and 2021, the stock market just ripped higher like crazy. And all of a sudden, these same clients are sitting there and they're like, we have way more money than we thought we would have at this point. We're just going to retire now. And, by having that kind of customized investment portfolio, we're able to help them kind of retire, but also make sure that we're making those changes right away to say, hey, your time horizon for when you're going to actually start needing this money is now. It's not in 2025 or 26, something like that. Yeah. So it's really, it is when you start thinking about that major life change, it is just really important to make sure you're getting good advice and you're thinking very proactively about that, because the last thing you want to do is kind of get set on, I'm going to retire, but I'm still invested as if I'm 25 years old, and OPS, the market just went down 30%, and now my retirement dream, I'm having to either delay it or I'm going to have to work a part-time job or whatever it is. Like, we don't ever want to see people have that happen to them.
Yeah. No, I think that's really helpful. And you're right. It's so important because we don't want to see that. One of the other big things that people can gain from this is just tax efficiency. So with investments, you are making money. Your investments are growing. And so how is that growth taxed? It's one thing if it's in a 401k, but when we think about, maybe high net worth investors who have larger portfolios, they're investing in 401ks, yes, for retirement. However, they're likely also investing outside of that. And so if you are a good saver, you've probably built up funds outside of the 401k where you might be forced to use these holdings, but you don't need to be using them outside of that. So even just different types of accounts and what you own is so important.
Yeah. It's really, in those cases, it really comes down to account type and then, tax efficiency. So target date funds, generally speaking, you're going to find these in mutual fund form. And the one issue with mutual funds is by law, they have to spit out dividends and capital gains each year of whatever was generated during that fiscal year. And there have been issues. Vanguard actually had a big issue in 2021 with their target date funds. They ended up paying out a massive part of their fund in the form of dividends and capital gains. And that does two things, particularly if you're a high-income earner. Number one, you're getting dividends and capital gains that you have to pay tax on. That, that's one problem. But then that money comes out. If you don't reinvest that, or if it's not automatically reinvested, then all of a sudden you're not invested for retirement anymore. You're invested in basically cash, and you have to figure out what to do with it. So target date funds, particularly, again, for high income earners, maxing out the 401k, maxing out IRAs where they can. Most cases, you're not going to find that that's going to be enough to kind of get through retirement. So you do have to invest in a taxable account. But when you do that, you want to make really darn sure that you're doing so in a tax-friendly way. Because, we've done math. It's in certain cases, you can lose 0.5% or 1% of your annual returns just on taxes if you're not invested appropriately. So, and target date funds really, in that case, they might not be very tax efficient. The other thing I would mention, just with kind of early retirees in particular, who they're high income earners. We're going to retire at 55 or 60. We're going to have a couple years where we want to pay for travel, but we have to pay for health insurance, things like that.
Right.
That taxable account, we will actually invest that account, which is going to cover those expenses, differently from their long-term 401k and IRAs. So we might invest their taxable account more conservatively, so that they know the money's there when they're going to start needing it, and leave more of the investment risk and kind of growth opportunity in their retirement assets that they're not going to really touch for another 10 or 15 years. So, that's something a target date fund isn't going to do. It's not going to know that, you might have this bucket of money that you're going to use sooner rather than later. And, that's why it's just, again, as you get closer to retirement, it's just, you really have to kind of think differently about how you're investing.
Yeah, and I think one thing that I've kind of heard as we're talking about this, so target date funds, while maybe this is the only choice that you have in your 401k, something just to really be thinking about is, just because those might be the only choices you have, everything else that you're investing can be invested so that if that's the only choice there, you can fill in the gaps in these other accounts. So we always view clients' funds, their assets that they're trying to invest, as kind of one big bucket. You're one household, but there's many different accounts that make up that household. And so, like you've just described, all of them have different purposes. Some of them, we want all the taxes, any funds that are going to generate taxes or any effect of that in a Roth IRA or an IRA, because those you don't pay tax on each year. And so there's specific places to put those types of funds. So I guess I just think, okay, so if I'm choosing these target date funds on purpose, like if I'm choosing them, what am I missing? And so you kind of highlighted maybe some of the costs, like the expense ratio that these typically have. And when I think about that, it seems similar to maybe what you would pay an advisor. So if it's 0.6%, 1%, that's what you would pay an advisor. But there's so much more value that you're getting by working with someone who's going to customize things for you. There's so many more things you can get help with. So it's kind of, when I think about that, we know there's so much that people are missing. Because you can be getting advice on other things, and everything can be working together.
You're not just, if you buy a fund, you're paying the expense, you're getting an investment. If you're working with us, for example, you pay the fee, but you're getting the investment and all the advice that goes along with that. Just to deal with what's going on in your life and how that might change, and your plans might change, or unexpected things might happen. So you get a lot more, I would say, non-investment value out of that fee than you get just buying whatever fund off the shelf.
Yeah, no, that's helpful. Anything, I guess, as we kind of think back on anything that you would want to share with people, any closing thoughts, I guess, or encouragement you have for people that even if this is all you have, it still can work for you. It's just being thoughtful about it. Anything?
Yeah. I would say, listen to our last episode where we kind of talk about investment allocation. Target date funds are a really great first step to do that. They do that for you. You don't have to think about it. So it is a really good option for a lot of people, particularly if you're young. It's just mainly as you get older that not even older, like 40s and 50s, where it's like, okay, let's actually kind of hone in on what we're doing. Let's get more detailed advice. And honestly, as I mentioned at the outset, a lot of these funds are really created to be just super simple and appeal to the masses. And what we find with our clients, there is no cookie cutter with what they are going through. There is no cookie cutter with somebody going into retirement. There's no cookie cutter for somebody in retirement, or if they suffer a life change that's unexpected. And that is really, cookie cutter works for a while, but it doesn't work after a while. And you really do want to get something that is customized for what you are precisely going through right now. And that can be adjusted as your life changes, which it will. So that would really be the big thing is graduating from kind of the cookie cutter into something that is more applicable to what you're actually going through.
Okay, no, that's really helpful. And I think just really helpful for people to kind of hear that encouragement of, it's okay to feel like, okay, I'm at a point where maybe I need help figuring these things out, or I'm just starting and I know how these could be useful. So
Yeah.
Well, thank you for explaining it. Thanks for digging into these funds, because I know you look at them for clients, because we know clients have them in their 401ks. So we're always looking to see, well, should they use them? Should they not? Is there something better? So
I love doing this. I remember when these things first came out. That's how old I am. And we were actually invested in a stock that was a big player in this new growth area, these target date funds, and it's interesting just to see how they've kind of matured and gained wide acceptance over the years. So it's good stuff.
Yeah. Well, thank you so much, Rob. So there's no such thing, we don't think, as a one-time financial plan. Successful investing isn't something you can set and forget. The strategies you need to use will change as your life does. That's where you need an experienced guide to bring confidence to your family's finances at every stage of your life. So if you're tired of asking questions and searching the internet for answers, then why don't you schedule a meeting with our team? We'd be happy to discuss how we can partner with you. And we will see you on our next episode. Thanks for listening.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.